Let's bring in Savita Subramanian, head of U.S. Equity and Quantitative Strategy at Bank of America Securities. Savita, great to have you with us.
Great to be here, Melissa.
Is the market more concerned about inflation than the Fed, and is that the right position to be in?
I think the market is concerned about inflation, and I don't necessarily think this is just transitory. And I think that what's maybe potentially worse than a long-term run of inflation is just the tightness of the market right now. And I think what's interesting is that you're seeing not only demand shocks from this reopening, but you're seeing a shortage of workers. You're seeing a lot of gumming up of the systems from supply chain disruption. I think that this microcosm doesn't just happen and then life goes on as usual. So I think that's market participants aren't necessarily, or I think the market is starting to pay attention to the idea that this inflation shock is actually pretty extreme. So I'll just give you one example of, kind of some of the data that we're looking at. If you look at the number of companies that have cited inflationary pressures, be it labor or raw materials, we've seen an 800% increase year over year in the citations of inflation. I mean, this is monstrous. We had to literally redraw the chart. It's like an asymptotic line. So I think there are a lot of these types of, anomalous shocks that are heading into the economy right now that don't just get absorbed nicely and life goes on. And I think that's what the market might be reacting to. The other kind of aspect that I think is really interesting is that we get these questions about valuations. So, if you look at the valuations of financials today, they're higher than they were a year ago. Doesn't this mean we should sell? And I think what's remarkable to me is that when I look at the average mutual fund and what they're holding today versus what they're holding a year ago, they haven't really changed that much. And this is what's shocking to me, is how little reaction we've seen in positioning of the buy side of the long-only investment world in terms of where they're invested. They're still positioned for a disinflationary, tech leadership type of market environment. And I think that that's what's really going to surprise people, and that's the pain trade going forward.
Savita, 8 million, 9 million job openings out there. Seemingly employers can't get people in those jobs, but they will if they start to raise pay, right? And we saw it anecdotally with Chipotle said they're going to raise the minimum wage to $15. Is the market going to raise minimum wage for the politicians? And is that the final piece of the inflation puzzle, wage inflation?
Oh, absolutely. So this is a key reason that we downgraded consumer discretionary, the sector, to an underweight about a week and a half ago. It's the idea that the companies that are most impacted by minimum wage inflation are actually, a lot of these services companies, a lot of these retailers, and that's where you're going to see the margin compression. This is sort of a typical mid-cycle type of market where you start to see upward pressure on rates, on commodity prices, on wages. And I don't think it's doom and gloom for margins. In fact, I think that a lot of companies can absorb these costs, at least, over a longer period of time, because demand will also be resurrected by this reopening. But I do think that we as investors should avoid some of the stocks that have chronically seen margin pressure coming into a wage inflationary environment. So I would avoid consumer discretionary stocks. Those are the primary culprit. The sales to labor ratio for those companies is the lowest that we've seen across all sectors. So that's one casualty of wage inflation. And to your point, I do think that's the final shoe to drop. I mean, I think we've seen it in commodities. We've seen it in copper. We've seen it in oil. We're starting to see it in wages. And I guess the bigger question is, are folks not working because they're collecting stimulus checks? And will they come back online when that runs out? I mean, that's something else we need to think about. But I do think this tightness in the labor market is going to be a bit painful for some of the more labor-intensive companies.
Hey, Savita, it's Tim. Thanks for joining us. This is less quantitative, which is your wheelhouse, than it is qualitative. But a shoe that maybe has already fallen is the sense that the guidance from companies that their business has come back, or at least that they're close. Yesterday, we listened to Simon Property yesterday say that they're at 95% pre-COVID rent collection, which is extraordinary, even if malls are under pressure in a secular trend. What do you think about that as you look at the market and the dynamics that you watch every day and your dashboard dashboards, your canaries. Are you worried about, because I guess I am worried about, once companies tell you we're back to good, that's not good for stocks, that's bad for stocks.
Right. It's all expectational. I mean, it's a great question, and I think a lot of measures show that we are back to pre-COVID levels. We're tracking a very robust economic reopening, so I think those are generally positive. Look, I'm super bullish on earnings growth for this year. We're expecting over 30% EPS growth for 2021. This is a monstrous number and a huge recovery. We could clear pre-COVID 2019 levels by the end of this year. So I think this is all good for earnings, but I don't think it's necessarily going to be good for the S&P 500 writ large. So I think there are pockets of the market you want to be in. And I was listening to all you guys talk in the last segment, and I totally agree. I think that materials, energy, CapEx beneficiaries, financials, those are the types of places we want to be in this market environment. But the interesting thing is nobody's there. There's still chronic underweights in the average portfolio. So I think those are the areas that still have a lot more juice. And, to your question about does it get bad when the second derivative changes and expectations are back to normal, potentially, which is why we're not so enthusiastic about stocks in the second half of this year.
All right, Savita, great to get your perspective. Thank you. Savita Subramanian, Bank of America. So that can happen in terms of expectational changes at the same time that this transitory or not transitory inflationary environment happens, at the same time that in the fall, and this is what Citi's CEO Jane Fraser pointed out today at the Economic Club of Chicago, in the fall when a lot of the additional unemployment benefits and eviction moratoriums come off. I mean, this is sort of a potent mix of different things that could hurt the consumer in the not too distant future, Tim.
Yeah, I think they could. And again, we've had a consumer that's had so much pent-up demand. They've also had pent-up savings. But at some point, you're going to get back to reality. And I do think while there is wage growth, I think we're seeing it in selective industries. I think there's a lot of industries where frankly, there's not necessarily a lot of pricing power. So agree that I think the financials have been a great place to be hiding out. At some point, I bring it also just back to consumer credit issues, possibly corporate credit issues, and things we're just not talking about right now. But if there's this much pressure, these will come to the fore.
Yeah, Karen, just quickly, in terms of consumer discretionary and the impact of wage inflation, I mean, the sales to labor ratio, I think that was an interesting way of looking at it, because that is low when you when you look like at a retailer, for instance. Any retailer, you've got all these people on the floor, and how much in sales are they making per person?
Right. Well, that is a good point, but I think you could kind of flip it around and look at it the other way, that you have a lot of people who are working, who are now getting $15 an hour, who do, some of that workforce tends to be spenders. And so they have some money to spend now, or more money to spend. But also, I think that retailers are getting a lot more efficient with their labor. And certainly the shift to e-commerce for retailers is less labor intensive, I believe, than having people out on the floor. So I think it kind of cuts the other way, potentially.
Interesting there.
Shepard Smith here. Thanks for watching CNBC on YouTube.